In our previous Chapter 3 video, we focused on the income statement and the balance sheet. In this video, we're going to build a simple framework for thinking about the common sources and uses of cash. And once we've done that, we will use that framework to prepare a statement of cash flow in our next video. So when we think about common sources of cash, one of the first things that might come to mind is that we generate cash when we sell something. And this, in fact, is the primary goal of most businesses, to either sell a good or a service. Now, when we sell something, that's often associated with a decrease to a non-cash asset account. So for instance, if we were to sell inventory, which is a non-cash asset, the inventory account would decrease, and that would be a source of cash. So in general, we might say that a decrease in a non-cash asset account is a source of cash. On the flip side, if we were to borrow money by taking out a loan or by drawing down on a line of credit, that would represent an increase in a liability and would also be a source of cash. Or if we were to raise equity capital by selling common shares, that would represent an increase to our equity account and would also be a source of cash. Let's now consider the opposite. So one of the primary uses of cash occurs when we buy something. And again, oftentimes when we buy something, that's associated with an increase to a non-cash asset account. So the reverse of our previous example works fairly well. If we were to purchase inventory, or perhaps even equipment or machinery, all of those purchases would be associated with increases to non-cash asset accounts and would indeed be a use of cash. And finally, if we were to pay back a portion or all of a loan, that would represent a decrease in a liability and would be a use of cash. Or if we were to use funds to repurchase common shares, such as what we saw in our previous video on the balance sheet, that also would be a decrease in an equity account and therefore a use of cash. So this is our very general framework that we've built up in just over 2 minutes. And at this point, you may choose to take my word for it that this all makes sense, but I certainly wouldn't blame you if you have any concerns. And in fact, I might hope that you would. So for instance, you may say, Nick, what about when I use cash to pay an expense? Isn't that a use of cash? And I absolutely would agree. So if we pay some sort of an expense, like a phone bill or some other operating expense like that, that's not going to impact our asset account, and yet it is still a use of cash. The way you want to think about it is that any expense is going to show up on the income statement, and it will have the impact of ultimately lowering our net income. But a lower net income would tend to generate a lower increase to our retained earnings. And since retained earnings is one of our important equity accounts, we can say that an expense is directly associated with a decrease ultimately in our equity account. And so for that reason, we are able to reconcile it perfectly. An expense is a legitimate use of cash. Here's another example. A couple of years ago, I purchased a car. If I were creating my own personal balance sheet, that car would represent a non-cash asset. And since I'm purchasing it, that would be an increase in that account. And yet, I didn't use any cash to purchase the car because I financed the entire purchase with Honda Canada. So I took a loan. So how can we reconcile this? Well, when you think about it, there's really two simultaneous transactions happening here. When I took the loan from Honda Canada, that represented an increase in a liability account, which is a source of cash. But instantaneously, that cash was used to purchase the vehicle. So I never actually even saw it. The whole transaction happened also simultaneously. So what we have here is two offsetting transactions, a simultaneous increase to a liability and an increase to a non-cash asset that perfectly offset each other. What other concerns might we have? Here's perhaps one of the most important ones. You might say, is it always the case that when we decrease a non-cash asset account that it represents a source of cash? Well, certainly not. Last video we saw that we can decrease our fixed asset account by recording a depreciation expense. And yet depreciation certainly, or that transaction is certainly not a source of cash. So this is definitely something that we want to take note of and make an adjustment for. This would be true for any type of decrease to an asset account that would be recorded as an expense. So another example might be amortization, which decreases intangible assets, perhaps a bad debt write-off or allowance for doubtful accounts. That would decrease our accounts receivables. If we were to write down any of our inventory due to loss and theft or just decrease in value, those would all be decreases in our non-cash asset accounts, and yet they wouldn't be sources of cash. So this is an important point to consider. And again, one way to reconcile this in our mind is that even though we're seeing a decrease in non-cash asset accounts, we're also seeing expenses on the other side of that transaction, which would ultimately decrease our retained earnings and our equity account. So it sort of offsets that transaction. So now that we've created a framework for thinking about the sources and uses of cash, in the next video, we will apply this framework to create a statement of cash flows. Now, in order to create this statement, we will rely on the information and data that is in the income statement and balance sheet from our last video. So you'll want to make sure that you have those accessible to you as you move through our next video. And those are available to you on our OWL website.